Hey everyone, Brian Bogner and Greg Towner with Parallel Financial, and we are here to talk to you about our February market outlook. So let's get right into this, okay? Unless you're sleeping under a rock or hiding out in a cave somewhere, you know that the market is making all-time highs, and not just, normally we'll show the S&P 500, large cap stocks, but this is the broad market, small cap stocks, international stocks, emerging market stocks. All of these areas of the stock market now are participating and moving higher, and it's been a very, very bullish thing. But that isn't even yet the full story. So let me turn it over to Greg. Greg, take it away.
Yeah, thank you, Brian. Last month in our outlook for the year, we talked a lot about rotation. We're seeing money moving into new areas, and that's continued in the past month. If this chart here is an ETF that follows a broad market of commodities, that's continued to push higher, led by oil and some other commodities, copper for sure. But we're definitely seeing rotation. You referenced emerging markets; they're moving higher. Commodities are moving higher. Small caps, different areas of the market that hadn't done a lot, or certainly hadn't been leaders in a while, are continuing to push higher, and we think that's potentially has some legs to it looking forward. Really, though, what is the big conversation going on in the market right now is interest rates. They've shot up here recently. Last summer, the 10-year note was as low as about 0.5%. It's moved up quickly here in the last few weeks to about 1.3, and there's a lot of concern. Hey, is this the rate's gone up too far, too fast? Is it going to be a problem for the stock market? We looked at a lot of data on this. For the most part, when rates are going up, it usually means the economy is doing well, and typically stocks are doing well during that period as well. There's been some comparisons between the 1950s and this current period for a variety of reasons. The government had a lot of debt, interest rates were low, and so forth. But during that period, even though rates rose quite a bit, moving from around 2% up to around 5% throughout the decade, and we even had 2 recessions during the period, stocks followed yields higher, finished the decade up almost 500%. So it's not a prediction of what this next decade holds, but it just shows that rates moving higher isn't necessarily a bad thing. What we think it will do is make the leaders that had been the leaders the last handful of years probably no longer be the leaders, and it's going to be new areas that investors are going to have to focus on.
Yeah, and I think that's important, Greg, because a lot of times we talk to investors all the time, and they tend to chase returns, right? Well, what's done great over the last 10 years, or what's done great over the last 5 years? Well, that's what I want to own. Well, just to your point, we're starting to see a big shift just in a lot of the fundamentals in the market right now. And so that foundation that had those things doing well for the last 10 years is changing. So likely what has worked may not be working over the next 10 years as well. So it is important that if you haven't looked at your portfolio review, I mean, obviously, if you work with us or you're one of our clients, we're doing this all the time. But if you're not one of our clients and you'd like us to look at your portfolio to really see, are you positioning for some of this rotation and changes right now, please talk to us. All right, back to the presentation.
Yeah, I mean, as far as interest rates, though, while a lot of rates have been going up, let's not forget the short-term rates. The Fed funds rate for the last almost year now has basically been at 0%. And the Fed is not likely to budge rates in a while. So the short-term rates, what you can get at your bank or in your money market or on your CD, that sort of thing, is likely to stay at or near zero for the foreseeable future. So as we start to wrap up, we think it's important to talk about some things that are going to positively affect the economy over the next couple of quarters. Fortunately, this chart here shows that the COVID cases have come off quite a bit from their highs a couple of months ago. So obviously that's a positive. And then we're seeing the vaccine distribution rate greatly increase. So that's been a positive. And then of course, stimulus. Stimulus is going to continue from the fiscal side, from the monetary side. All of those things combined together are likely to see the economic numbers over the next couple of quarters come in extremely strong.
And if you're watching this video, you also got an email last week. Greg put out a great piece talking about stimulus and the bull market. If you've not read that, you definitely want to read it. It's also on our website as one of our blog posts, but some really good stuff around that as well. So in summary, market strength continues broadly. Interest rates are rising, but that's not yet a huge concern. I mean, let's be honest. The 10 years at 1.3%. Yeah, it was at 0.5, but it's only at 1.3%. It's not even at an inflation rate or anything like that at this point. Okay, it's not even matched that yet, so it's still historically low. Central banks continue to keep short-term rates low and are pumping a lot of money into their economies right now. And COVID cases are dropping, right? Vaccines are being rolled out. We've got stimulus. There's a lot of positive tailwinds here to the market. So if you have any questions, give us a call, shoot us an email. Thank you so much for listening, and have a great day.